So I would like to introduce our guest speaker, Jim, who has been with the Boston's Federal Reserve for 37 years. Jim has always been in payments, technology, security, and innovations. However, right now he's responsible for an industry effort to reduce fraud in payments and technical research related to fintech and central bank digital currency. So thank you so much, Jim, for joining us. And I will share my screen with your PowerPoint.
Great, thanks, Christine. I appreciate the invitation as we wait for this to come up.
Sorry.
So think of slideshow for, yeah. So starting, first of all, thanks for the invitation. I really appreciate the opportunity to be here. As Christine said, I'm Jim Cunha, EVP at the Boston Fed. And I'd like to, well, first of all, let me say the normal Fed disclosure. I'd like to make sure you know that these are my words and thoughts, not necessarily those of the Federal Reserve. If you follow the news, you know there's not a common voice relative to central bank digital currencies from the Fed, which is fairly normal at this early stage. But I also want to encourage, if you have questions, feel free to put them in the chat. And I'll ask Joe or Christine just to bring them up as they show up, if they're relevant to what I'm talking about. And we'll have plenty of time at the end to talk about things. I give a lot of talks on this, and I always start the same way. One of my undergraduate degrees is in philosophy. And the beginning of my Chinese philosophy class, the professor said, "You don't know what Chinese philosophy is today. You're really confused. At the end of the semester, you'll still be confused, but at a higher level." So my goal is not to make you experts. My goal is just to get you to a certain level of understanding of what CBDCs and stable coins are, and then what their role might be. So let's get going with this. Next slide is just an agenda. So I'll talk about what CBDCs are, what's happening around the world very quickly. What are some of the key questions we're trying to answer, and then end up with a topic called stable coins. So if you go to the next slide, we'll start to talk about digital money. So when you talk about CBDC, central bank digital currency, people say, well, money's already digital. So these are the different ways you can think about digital money, and they do vary. So you're all familiar with what's in deposits in your credit unions. That's financial institution funds. It's backed by the good faith of you. It's considered financial institution monies. And basically, you're the conduit to that money for your customers, and you help them make payments with it. Cryptocurrencies, on the other hand, we won't talk about them much, but I'm more than happy to take questions later. Here you're talking about Bitcoin or Dogecoin or Ether. These are private cryptocurrencies that have no central bank backing them. There is no financial institution backing them. There's no country. There is really nothing except for a consortium of developers that write the code and manage the network. Very high price fluctuations, as you've seen Bitcoin. When I first started looking at it, it was about $40 a Bitcoin. Now it's 60,000 or so per high volatility of the movement. The third is stable coins. So stable coins are a certain type of cryptocurrency that are trying to create a stable value, as the name implies. Usually they're pegged to the US dollar. And what happens is, instead of just being the value goes by supply and demand, like cryptocurrencies do, they back up the coins with deposits. So if I buy $100 worth of a stable coin, theoretically that $100 goes into a financial institution or some sort of asset that backs up the coin. So what you have then is the potential for a stable coin, which still acts an awful lot like a cryptocurrency, in that it can be traded very easily, moves around the world very simply, and doesn't have a backing from a government or a central bank or anything. Okay, there we are, we're back. Then the far right, we have central bank digital currencies. So these would be issued by the central bank. They're central bank money. So right now, central bank money is either cash, paper currencies, or reserves. Reserves that are deposited by financial institutions. So this would be a third type of central bank money, which would be on our books, but directly held by consumers and businesses. There's two types: retail, which is what businesses and consumers would use, and then wholesale, which would be interbank transfer. So think about wire transfer in a case like that. So if we jump to the next slide. And so why is the Fed and many central banks looking at this now? The next couple of slides will look at all the countries that are looking at central bank digital currency, the retail kind. But most importantly, China announced that they've already built this and they're in a production pilot. So China already has a central bank digital currency that they're using with consumers. Facebook announced that they have their project Libra, now called Diem, and this would be a private cryptocurrency that is on the books of Facebook or a consortium. It's backed up by the money that you deposit. So you could use it on Facebook, you could use it on any of your other social media apps. JP Morgan has a JPM coin, and then Bitcoin and stable coins are growing. But really the most important reason that we're looking at this at the Fed is that in March of 2020, there are two bills introduced in Congress as part of the CARES Act. Now, they didn't get passed, but they would have directed the Fed to issue a CBDC, create accounts for citizens and issue a CBDC. So when Congress starts to pass bills or attempts to pass bills, it's really important for the Federal Reserve to understand technically what would it take to issue a CBDC. So that's what we're doing. If you go to the next slide, you'll see a bit more about what's happening around the world. I mentioned China is in production pilot. Bahamas and the Eastern Caribbean Bank, central bank, they've already launched a cryptocurrency called the CN dollar and then Dcash, respectively. You know, Sweden's a unique case. The paper krona, the currency of Sweden, is barely in circulation. So Sweden believes that the central bank should issue a currency to the people and businesses. But if no one's using the paper krona, they're looking at whether they should issue a digital version of their currency, a CBDC. Now, what's important here is the message is, first of all, a lot's going on. There are 100 central banks around the world, either doing research in wholesale or retail CBDC, so a lot of action. You've got different reasons why central banks are looking to issue this. The Bahamas and the Caribbean Bank, it's really expensive to move money on the islands. So for them, it's an efficiency play. I mentioned Sweden, their currency is barely in circulation. So for them, it's really to stay connected with their citizens and businesses with some form of a fiat currency. You know, China's motives are talked about a lot, and sometimes they're talked about, you know, in nefarious ways, sometimes just in, you know, other ways of offering benefits. So I won't get as deep into China's motivations, but I think they're not necessarily all what people say they are, even on the negative side. If you go to the next page, you just see that, you know, many developed nations and many developing nations are looking seriously at this. So once again, if the whole world is looking at this, it really behooves the Fed to also, you know, look at this as well. If you go to the next slide. So what we're doing at the Boston Fed, it's called Project Hamilton. And I'll give you a fun fact. It's named obviously after Alexander Hamilton, but also because we're working with MIT, it's named after Margaret Hamilton. So Margaret Hamilton was a woman in charge of a technology lab in the 60s at MIT, and they developed the guidance system for the Apollo space program. So we really want to be a nod to Margaret Hamilton as well. But what it is, it's technology research. So I'm not building a production system. I'm building a theoretical system so we can study and understand what does it take to build a digital currency. We're going to look at different ways of doing it. We're not just doing one. So we're trying to learn. And we're also technology agnostic. You know, a bunch of countries are saying a CBDC should be built on blockchain, you know, the technology that underlies cryptocurrencies. Other countries are saying, no way, I'm not using blockchain. We're agnostics. We're going to look at it, but look at other ways of doing it. And what's exciting about this is we're about to publish our first set of research results with MIT. So it's a joint publication. This is very technical, but also something the Fed has never done. We're creating an open source license for the code. So this code will be out there for anybody to see and contribute to. One, we want to make sure the world is learning from what we're doing, but we also want to make sure that we get more contributions from people around the world, either private sector, other central banks, or even financial institutions. We've talked to some of the largest financial institutions, and they're interested in trying to contribute to the code. This makes it better, it makes it safer. And instead of having 10 developers, I could have hundreds of developers working on this. So go to the next slide. We'll talk about more specifically, what are we doing? So phase one is basically done. And what we've done is we've built the core engine. So just think of this as the software that mints the money, stores it, and moves it. Now, it's easy to do that, but it's not easy to do that at scale. So when you talk about the United States, we set some very, very high metrics. We're talking about tens of thousands of transactions per second. So really talking about the speed of all the credit card brands combined. That's the numbers we're trying to push for. Speed, clearance settlement under 5 seconds, and really resilient. This platform can't go down. If we really did go to production with digital money, it can't be offline. It can't go down. It can't slow down. So how do you do that? That's what we're looking at during this first phase. And like I said, we'll be publishing the results of this research and open source license very soon. Phase two then goes into some more complicated questions about policy trade-offs. We'll talk about them later. There are a million questions to answer about policy. And so we'll be coding different policy options to understand, what do they do to our system? Do they slow it down? But also there are policy options that are at odds with each other. So you all understand that privacy of payments versus catching the bad guys and anti-money laundering are at odds. The more privacy, the harder it is to catch the bad guys, et cetera. So we'll be programming many of these. And once again, publishing our results and publishing the software. So that's Project Hamilton with MIT in partnership with both designing and coding together there. And they're one of the most advanced universities around the world. If you go to the next slide, what the Fed is also doing, we got some great people at the Fed in Boston. We hired some great outside talent from cryptocurrency organizations, but we can't presume we're going to build the best option. So what we're doing is we're also looking at what's out there today. There are open source platforms like what powers Bitcoin, what powers Facebook's Diem, that could be a source of how we build our CBDC. And there are private sector actors that say they've already built something that can, support the US. So we're going to look at all of those, do a comparative analysis and say which ones can meet our needs. So if we find a platform that can do 2,000 transactions per second, it's not going to cut it. It's not enough for us. So we won't even go further. So we're going to find the best. And then we'll bring some into our labs and test them. So the goal between the MIT work and this is, over the course of the next year or two, we'll be fully informed of what's possible. If any of you have ever worked with building a system from scratch or even buying a system, it's really hard. It's really hard to find the best and make sure it works. So we're getting a head start on it. We do not have the mandate to go to production. But if you think about it, if we got a mandate in a year or two, we're 2 years behind from what we can do. So that's our goal, to learn and to share. Go to the next slide. We'll talk about use cases. So what would a CBDC be used for? A lot of discussion about this. And this is actually in order from person to person down to business, really in the order we think it would be useful. So person to person, best use case for a CBDC. Consumer to business. You walk in at a point of sale, you can use CBDC. Today, you can buy fruit in China by pointing your phone at a QR code, and your phone can actually transmit money through WeChat Pay or Alipay or one of those systems. Why can't we do that with CBDC? The business to consumer. Why can't an Uber driver get a payroll via CBDC or a refund or distributions from government? All these are things that we think a CBDC can be used for. Now, These can all be done with other payment systems, but in some cases, we think a CBDC can actually be better. Cross-border is a really challenging payment, either wholesale or retail. They're slow and expensive. They get lost and you can't tell where your money is. So could CBDC possibly help with that? And then the last item says, if I build a CBDC platform and I make it really fast and really cheap, I think there's going to be so much innovation around that we can do new things. If you've ever followed the world of micropayments, paying 5 cents for an article on the Wall Street Journal or 20 cents to hear a song or something once, well, those micropayments are just too inefficient. But can we do them in the future if we have a platform like this that scales, and Internet of Things? So those are, we think, some possibilities for use cases. If you go to the next slide, though, it's not without risk. So one of the risks is disintermediation of banks, I should say, financial institutions, through lost deposits. What happens if someone moved all their deposits with you into a CBDC? Obviously not good. That does have risk. There are ways of mitigating that, but that's a real risk we have to understand. As I said, this is a Fed liability, which means any CBDCs issued end up on our balance sheet. So the Fed balance sheet expanding is something that could create risk. But if you think about more traditional risks, this will be attacked by everybody, nation states, anonymous bad guys, either to bring it down through denial of service or to infiltrate it, to create counterfeit. Individuals could try to spend money twice. We have to stop that. Privacy risks are real. And then what if the money is lost or stolen? Should we be responsible for getting it back? These are big questions, huge policy questions. So let's jump in for, right now, let's jump into some of the policy questions. Now, I'm from Boston, born and bred. So if you go to the next slide, and you can tell I'm from Boston because I have no accent, but we have a saying in Boston, don't pave cow paths. If you do, you get Boston streets. So to me, what this means is when we're thinking about designing a CBDC or trying to answer the many policy questions, let's not pave the cow paths. Let's not build it like payment systems work today and assume that's the right way of doing this. We can't solve problems if we do things the same way we've done them before. Let's think differently about policy. Might we be able to do some things unique? If you go to the next slide, we'll talk about many, many, many different design and policy questions. And a lot of these affect institutions like yourself and the people that will use, the corporations and the people that will use the money. So identity is huge, a big challenging one. So what does identity look like? And what kind of data has to be stored or secured, and from whom? Who can see the data? Today, if your customers make a payment and you create an ACH transaction, you get to see all that information. The Fed sees some of it. Well, how about with CBDC? How should that work? Financial infrastructure. And this is really important for all of you. And I think something you should be thinking about is, how is this money issued? Today, you get cash from correspondent, or another bank might get it, directly from the Federal Reserve, and then you give it to your customers, be they, corporate or consumers. Well, should CBDC work that way? Should it go through the banking system to get to customers? Should it go through others as well? And that's a cow path is it would go directly to the financial institutions and go to the end customers. But if we want to solve some existing problems, do we need somebody else to be an intermediary? And I'll expose my hand. I think CBDCs should be used to help improve financial inclusion. So do we need some financial institution alternatives like fintechs or others that can help with the unbanked and other financial inclusion challenges? And then based on how it's distributed, does that impact the bank deposits? Also, should it be connected to other payment systems? Should a CBDC be able to be turned into a FedNow transaction or real-time payment transaction or an ACH transaction? How does that work? So lots of questions here. Next slide. Cross-border, as I mentioned, can a CBDC, see, CBDCs right now are just being developed. Can we build them in a way that can make cross-border easier, faster, cheaper, and less opaque? Now, cross-border is not just a technology issue. So it's not just build it and you'll solve all the problems, but we can solve some of the problems. I mentioned security. How do we stop double spending and people from losing money? And there's an interesting debate around the world on monetary policy. Some people think if we had a digital dollar, we could help create a new monetary policy tool by putting an interest rate on it. If we want you to hold CBDCs, we could increase the interest rate. Obviously not good for banks and credit unions because that would mean drawing out of their deposit accounts and putting pressure for them to raise rates. So I don't think that's a good solution. Or if you want people to spend their money, their CBDC, you put a negative interest rate on it. That's not how we do it in the States. I said, these are my thoughts. I just don't think that that's what we would do in the US, but some around the world are talking about that. As I said, financial inclusion. Are there ways of having the CBDC designed to help solve financial inclusion issues? And to do that, my personal view is that a public policy goal, a stated public policy goal of CBDC should be financial inclusion. See, when you do that, when you state a goal like that, you may design it differently. You make sure it's cheap. You make sure that you find ways of making it accessible to everybody, not just those at the bank. So I think it's really important to create that goal. And I think of one, I get asked a lot, well, what's the use case? How could this help? So I think of a case where you get a single mother of two. She gets paid via a check. She has no bank account. She goes to a check casher and cashes the check. Then she buys some money orders because her utilities won't take cash and she has no other way of paying. She has no checks or credit cards, say. So she buys money orders. Maybe she sends a remittance back home to her home country, and that costs her a lot of money. So every one of those use cases could be done with CBDC. If we call it a public policy goal, and if we create opportunities for innovation by the private sector. That's why I think it's really important to state it as a public policy goal. But even that simple example with some innovation, you can see how we can do things differently. And one of the cow paths I mentioned is how we move money today, which eliminates some of the opportunities. If you go to the next slide, just one important one on this slide, which is, innovation. Some people say a central bank digital currency will squash innovation in payments and squash stable coins and cryptocurrencies. I think the opposite. I think a CBDC is a great platform for people to innovate on top of and create that new product that allows that single mother to get a paycheck through CBDC cheaply and to pay her bills without having to go through normal methods. So if you go to the next slide. So I get asked, what does it mean to me, especially a smaller financial institutions? First, it's important to note that we've made no decisions about going forward or not. I mentioned all these public policy questions. Well, the Board of Governors, they own the policy, not me, I'm a technology guy, but they're about to issue a public consultation paper that asks about these things. I highly encourage yourself or through the associations you belong to respond. What's important to a credit union? What would you want to tell the Federal Reserve about CBDC and other payment innovations that matter to you? We need to hear your voice, and I highly encourage that process to happen. As I mentioned, it'll be out fairly soon, this consultation paper. I say here, I think banks and credit unions will have access to a CBDC. So what would you do with it? How would you innovate on top of the CBDC? Just put yourself in a position in, say, 5 years, pick a time and say, the Fed's issuing a CBDC. How do I support my members? How do I ensure they don't move all their, and just for other reasons, how do I make sure they don't move all their deposits in our credit union to CBDC? How can I facilitate a new product or new way of them having CBDC, but also keeping their membership and accounts with my own institution? I think that's the strategic question every one of you should be thinking about in the association as an advocate or as a conduit for you to get together and brainstorm this. The analogy I use here is, I've been around forever, and I was here before that crazy thing, the internet was even created, in the World Wide Web. And I remember when the World Wide Web first came out, there wasn't a bank or credit union alive that would touch it. It was the Wild West. It's where bad guys and drugs and porn and kiddie pictures were, prominent. That's it. That's all the World Wide Web was for. There wasn't a single financial institution that would touch it. Then the larger ones started to, and creating web presences. And now I'm sure every one of you has a web presence. You're probably on the web. You're probably taking requests or loan requests or applications from members or future members on the web. So it's the same analogy. You were afraid early on because it was so new and not well designed quite yet. It wasn't secure. Well, CBDCs, people may think about them the same way. So be open to it. Not now, but I would say as this starts to evolve, talk to your technology provider and say, what are you doing to help me be able to integrate with CBDC? How do I allow my members to be able to get CBDC out of their accounts and then put it back in? So you should be going to your technology providers because that's your foot into this network. Much like you're probably thinking about that today with faster payment schemes. So that's it on the retail side. We'll spend a minute on wholesale, just to tell you what's going on around the world as well. So wholesale, obviously think wire transfer, and a lot's going on around the world. If you have interests in this at all, every one of these countries has a great set of reports on what they've done. Probably the best amongst them is Singapore with Project Ubin. And what they've done is they've tested basically creating a wire transfer, a real-time gross settlement system on blockchain, and then connecting them to other countries and moving money cross-border, payment versus payment, or moving money from their account into a security someplace else, delivery versus payment. So I won't talk too much about this, but there's just a significant amount of work around the world on wholesale. And I'll talk about the one on the bottom, Finality. That's not a central bank effort. That's a private sector effort. So that's a consortium of 15 of the largest banks around the world. And these are banks that do significant business in securities. So think of State Street, BNY Mellon, Santander, Barclays, UBS, et cetera. And they're building their own wholesale network. And it's really a stable coin, which we'll talk about in a second. But they're building a network so they can move wholesale money between these 15 banks. And you may ask, well, why are they doing that? They already have ways of moving money between them. And the reason they're doing it is because, these institutions believe that every security in the future, treasury bills, bonds, notes, derivatives, all types of financial instruments will be on blockchain in the future. And if those securities are on blockchain in the future, you need to be able to access money also on a blockchain so that you can actually move the security and the money at the same time. If you think about it, you take State Street and BNY, or State Street and UBS. If they want to move $100 million of securities between them, which is very common, and they don't have money on the chain, they'll have to try to move the security, then separately go to SWIFT terminals and wire transfer terminals and do it disconnected. So you have a challenge there where you want to move the money and the security at the same time. So this is telling me that the 15 largest banks in the world believe that there's a future not that far away where every security is on these blockchains and money will be there. So I know, and smaller financial institutions obviously are not working at the scale that they are, but to the extent that there are any securities in your portfolio or processes like that, then this is telling something about the future. So that's it for CBDC. Now I'll spend a little time talking about stable coins because they're really important development. This has really just been within the last couple of years, you've seen so much development. So as a reminder, a stable coin is a cryptocurrency that is designed to have a stable value. So basically, the goal would be that every dollar stable coin that's issued, there's some asset there that backs it up. Now, it could be a combination of things. Obviously, the safer the asset, the more trust you have that your dollars are safe. And then when you want your dollars, you'll get them. So treasuries, obviously, or bank deposits are the most secure way of backing this up. Some of these are, if you've ever heard of Tether, some of these are a little riskier because they've got assets which are not as liquid. They've got commercial paper. They actually have securities. So just think if they suddenly had to liquidate all of that to give people their dollars, they wouldn't be able to liquidate that commercial paper and those securities immediately. They're not as liquid. So these stable coins are not all created equal. And it's really important, to the extent that anybody gets involved with them, they understand what backs them up. And there's also a best practice that whatever the reserves are that back up that stable coin. So just say there's $50 billion of a stable coin. There should be $50 billion of an asset someplace that is audited and that is disclosed publicly. That way you can have some surety that what's behind that stable coin is liquid and is actually there. And that's a challenge. So if you go to the next slide, so what would people use stable coins for? And the major use case for these is buying and selling cryptocurrencies. See, the challenge there is if you want to buy a cryptocurrency and you've got money in a bank account someplace, it's really hard to get that money out to buy the cryptocurrency. A lot of banks don't want to be having a customer that is, buying from a crypto exchange, because do they know their customer? Do they know their customer's customer? I mentioned finality. So this would be a stable coin that's used for settling security purchases. You may have heard of DeFi. So DeFi is a relatively unregulated market that allows people to, in some cases, get together and lend money to each other without banks or credit unions. And the stable coin is sort of how they get liquidity into those products. Cross-border, if I have $10 million in a stable coin, and I know somebody in, pick a country, France, all I need to know is what their public address is. I give it to them, just like you do with Bitcoin and other cryptocurrency. So it's very easy to move cross borders. Also, if you're in a high hyperinflation country, say Venezuela, and you want exposure to US dollars because they're stable, well, you buy a stable coin. So if I have a $10,000 in stable coin, in a month it's worth $10,000, whereas my Venezuela dollars have diminished in value. But I will say that stable coins, I think they're pretty cool, but they're not really adopted yet for payments, retail payments or wholesale payments to any extent. If you go to the next slide, we'll talk a little bit about some OCC interpretation. Late 20, early 21, as you know, you may not know, but the former control of the currency under the last administration was a very pro cryptocurrency stable coin, and basically took existing regulation and issued a new interpretation. And basically says a bank or credit union, at least if it's in same interpretation from the credit union regulators, can hold stablecoin wallets in custody. So if your customer had stablecoins, you could host their wallet. You could hold their keys as a custody service. It also says banks can be part of a network that actually issue stablecoins and manage stablecoins. They could be part of that network. And they can even use stablecoins to make interbank payments. So a bold statement here, and I have to admit, I'm not sure where the credit union regulations are relative to this, but it says as long as you understand the risks and mitigate them. I don't know of many commercial banks that are touching these yet, but I think there's some potential. Go to the next slide. Just talking about some of the key risks. I mentioned these. Run risk. What happens if everybody wants to cash in their stable coins and the liquidity just isn't there because either it's not liquid, maybe it's securities, it takes days to unwind those, and maybe you have to sell them at fire sale risks. So there's a risk that you'll have a run. Someone's holding that money in custody. There's a risk that they fail or they screw up or it's stolen. And then if you don't audit it and disclose it, who knows what the risk is? Regulatory uncertainty. There are many arguing now, including Gary Gensler, who's the current commissioner of the Security Exchange Commission, says if I've got a basket of securities, commercial paper, treasuries, and they're earning interest, and some of that interest goes to the holders of the stable coins, well, that's a money market mutual fund. That's exactly how they work. So there is risk that stable coins will suddenly be regulated as money market mutual funds and maybe not have the things in place, the controls in place to satisfy that regulation, or the business model just doesn't work and they close down. So that's a real risk. Also, as some of these grow to great sizes, the systemic risk is potential is there if some of these stable coins get into the hundreds of billions or more size, and they have to be regulated then as systemically important utilities. And I won't get into it here, but there are a lot of technical risks. Actually, if you go to the next slide, we'll talk about where the technical risks are. And I'm not going to be I don't want to get very technical on this, only because the audience aren't technical, but I'll just say that there are a lot of technical risks connected with the fact that these stable coins really are cryptocurrencies. They're built on blockchains that act in very particular ways that people don't understand. And these blockchains are managed, governed by developers. So imagine if you had, $100 million of stable coin. And what you don't know is it's running on technology that is managed by a bunch of developers that also manage Ethereum, one of the cryptocurrencies, Ether. And they can change the rules on you. They can suddenly do things that devalue your stablecoin. So these risks are real, these technical risks, and they don't get a lot of attention. So just to say, if you ever, get into stablecoins or hear about them, these technical risks are real and really need to be understood. So go to the next slide, just talk about, so how much money is in stablecoins. I do apologize, this is a bit out of date. But if you look to the left, that slide, only going back, a year or two, there's almost no money in stablecoins. Right now, there's $125 billion that have been deposited into these stablecoins. If you go to the next slide, you see some numbers about the top players. So Tether, that's the one where, even though it's called a stable coin, there's been some controversy over what they have their money invested in. Tether actually got fined millions of dollars because what they actually had in their portfolio, and you may understand, credit risk, they had a loan to themselves as an asset that they had in their, bucket of funds. Obviously not a good asset. But you can see that Tether by far is the largest. Right now, I think it's about $60 billion worth, which means somewhere there's supposed to be $60 billion in deposits. USDC was actually created by a Boston company called Circle. They're up to about $30 billion. So these are growing. These are really growing over the last year or two. Whether they continue, I don't know. But so that's the last slide. So hopefully you've got you're confused at a higher level about what a CBDC is, what it might be good for, why the Fed is looking at it, and some of the really challenging policy questions that have to be answered. And the last piece is, if I was you, what would I be doing now? Just paying attention, trying to understand that particular dynamic. And then wholesale and stablecoins. I hope you understand those at a slightly better level. So let me stop there and see if there are questions. And like I said, I'll ask for someone to read the chat if there's items in the chat. More than happy to take them on these topics or even cryptocurrencies themselves.
Well, thank you so much, Jim. Oh, go ahead, Joe. Sorry.
So Jim, I was just going to say, I get to have exchanges with my counterparts in other states quite often. And the whole subject of cryptocurrency, has come up more and more in recent months. And a number of us have experienced, individual companies like NYDIG. I don't know if I'm saying it right or not, contacting financial institutions, both credit unions and community banks, saying they'll serve as kind of an intermediary, sort of as a means for a financial institution to look like it's providing cryptocurrency access to its members or customers, but without actually getting involved in it and whatnot. And I was just wondering, what you know about, well, obviously you know a lot, but what you think about those kinds of relationships for, Northeast type financial institutions, and what you know about them and all of that.
Yeah, I think one telling thing is even the largest financial institutions really aren't doing that. Most of them are not connected with having their customers directly through them buy and sell cryptocurrencies. I think that's for a reason, which is risk. So, how do you know where that cryptocurrency came from? And do you know your customer's customer? What would happen if your credit union member was doing this and then lost all their money on a bet on a very volatile cryptocurrency? Do you feel some sort of responsibility, or even, want to make sure that your customers are safe and aren't taking unsafe bets? Or is it just a matter of, providing them access to a different type of environment? What if they wanted to buy, penny stocks, through your organization? Would you give them access to a penny stock exchange? Or do you feel like, this is why I think credit unions are uniquely positioned, that they have a whole different way generally and credit and small commercial banks of thinking about their members, and protecting their members. And so I would say, do I want to open up that volatility, and can I satisfy my know your customer and anti-money laundering requirements? Maybe the letter, but the spirit, is that I'd be worried about that specifically. There are a lot of them out there. The other challenge is due diligence. How do you know that whoever you're working with themselves is reputable? Because your customer is going to see them as an extension of you. So how can you be sure that whoever it is, if I was going to go with anybody, I would go with the largest players out there. So you've got Coinbase. I'm not sure if Coinbase offers these services to individual financial institutions, but they're one of the largest providers out there. They are regulated. So I'm not saying just go and take my advice, but I would not go with a small organization that you can't find much about, because that's just going to exacerbate the, where did those currencies come from? Are the rates good? And then, when you own a cryptocurrency, the way it works is that you get a pair of keys, a private key and a public key. So I'm not sure how it works with these institutions. Do your customers have to hold their own private key as a way of proving that they are who they are? That just opens up a whole new Pandora's box of risk and loss of the keys. And then if you hold the key, then you're a custodian for them. That comes with risk. And if the institute, the organization you're connecting with to buy and sell the cryptocurrencies, if they're holding the key, that creates a whole new risk. Are they protecting the key? So it's a complicated risk. I mean, you have to start with, is this a service you want to offer members just based on the potential, risk to them by the volatility? And then if so, who's the best provider out there? And then how are they managing the very hard thing about the key that proves who I am has to be managed. If it's lost, they've lost their money. So I sort of throw that advice out.
So if I can ask a question of those of you that are still on the line with us, have any of you experienced an account holder coming into your credit union asking if they can, for instance, something like use whatever cryptocurrency they have as collateral for something, or something along those kinds of lines that you weren't willing to do? Nobody yet? I've read stories about that, and I've read that and heard from some of my counterparts nationwide that there's an increasing number of credit union members and community bank customers that are moving money from the account in their credit union or community bank into a digital format, and that the financial institutions just aren't, unless they're looking for that, they might not be cognizant of it yet, but that trend is growing because the whole activity in cryptocurrencies is becoming more popular with more headlines and all that, more people willing to test the waters and whatnot. So what do you think?
I'll add one comment to that, Joe. Yeah, I'll just add that this stuff's not going away. Cryptocurrencies aren't going away. Stable coins aren't going away. And forget all that. How about Facebook? How about DM? I'm sure most of your members have Facebook accounts. And what happens if they decide that, wow, most of the people I'm paying are on Facebook. Let me take $5,000 out of my credit union account and throw it into DM and use that as my person-to-person payment account. I mean, that's all going to happen. That's all going to evolve, and it's going to only accelerate. So to say that this World Wide Web is not going to happen that doesn't work. All these types of, just like the World Wide Web took over us, these things are all going to be out there, competing for, current systems. And then there's this whole DeFi of distributed finance. And once Facebook does it, got it on, you can tweet it, you'll find it on TikTok. I mean, all these things are going to follow the patterns of the big tech. So not to scare you, but just to say you need to understand it, keep track of it, and then see, how do I play, in this world as a credit union through my technology providers.
So one last question from me, and then I don't know if anybody has anything, but would you, if you were, well, why don't you go first, Jean?
No. Go ahead. I'll ask afterwards.
I was gonna. So Jean runs Vermont Federal Credit Union in Vermont. If you were running Jean's credit union, Jim, what would you be thinking about now? Knowing what you know, what would you be thinking about now regarding cryptocurrencies and the role for your financial institution at some point in the future? What do you think is going to look like?
Well, first, and I don't know the size or what kind of technology access she has, or if she goes through service providers, but I'd be making sure you understand how this is evolving. Both, I mean, cryptocurrency, you just sort of watch the headlines and the prices, and but I'd be watching Facebook's DM. I'd be watching stable coins. If I was you guys, I wouldn't worry about China, but those headlines do mean things. But if the whole world moves there, eventually we'd move there. So I think one is understanding what's happening, and think about it strategically. You think about what's the competition to your particular credit union. So during some of these sessions, say, what happens if Facebook's launched and it's really easy to put money in DM, and my members can do it really easily? Am I at risk? Then I talk to some of your members. Have you heard about Facebook? Would you do that? I mean, I don't know how you interact with the members, relative to what their needs are, but I want them to understand, do they know about this? This is not going to change your world tomorrow, but, we all have the strategic plan. So in your 3 to 5 year lens, you should be thinking about this. This could be, as they say, things are overestimated in the short run as far as the impact, and then they're not. I think this is going along. It's going to go around slowly, and then suddenly you'll see 20% of your customers moving money to Facebook or TikTok or whatever the new thing is, or maybe to my CBDC. So I really think that understand it as it evolves, understanding how can I service my customers? Like I said, not now, but at some point I'll be talking to the technology providers and say, are you aware of what the CBDC is? I mean, some of them are really slow even to get to real-time payments. I'm not sure who your servicers, but it's always part of the challenge. But even the big ones, the FISs and the Jack Henrys, sometimes it's slow for them to get to these new payment products. And so I'd be pushing them, saying, we need access to this thing that the Fed is saying is coming out in 2025. It's not today, but, strategic planning says, think about it.
So my question was more of a comment, I guess, and I'm thinking about the dissolution of where deposits are. So you have an account with DM, you have an account with Zelle, you have money at Venmo. I mean, people are going to have pieces of money in all sorts of different places, because you're going to be with one stable coin, and you're going to trade with somebody, they have to have the same stable coin, and you have to have something to back it. So it seems like it's a good thing that the Federal Reserve's getting in, so that we can have something that's universal.
Yeah, and I think a good analogy is, and I was fascinated by looking at this, was in the late 19th century, currency was issued by banks and municipalities, right? So if you're in Boston and you got a First Bank of Chicago note, you didn't trade at par. So the analogy of private money and the fungibility and accessibility and par trading of those things, it's going to happen. I'll take your stable coin, but it's tether. I'll give you 90 cents in the dollar. I'm not so, and that can erode buying power. It can erode economics. And it's so many things it erodes, and it leaves liquidity spread out all over the place. So it has so many potential negatives that, I think that's another reason why we need to have a ubiquitous, stable central bank money that we're not trying to squash them all, but we need to have that so that if you want to trade at par, you take out a $10 bill or CBDC.
Right.
A great, yeah.
Any questions from anybody else? Comments? Anything? Observations? Going once, going twice. Back to you, Christine.
I just have to mention, though, I see Steve Roy on his name pop up here, so I guess I'll be talking to Maine sometime soon. Steve and I niche board together. We go way back, and I've done some great work with some sessions he's had on payments and things like this. So,
well, I mean, you may not know him yet, but my counterpart from Massachusetts was on the line too. So you may be getting a phone call from him as well. Hey, Steve.
I know, Steve. Yeah, I spent a lovely day with, or most of a day with Steve, and a session he had pulled together. Had a nice drive up to, I forget where we were, maybe not Camden, but we're someplace really nice on the coast in Maine. So it was a great event. But
well, thank you so much, Jim. We appreciate you being here with us, and this was very informative. And it is recorded, so we will, anybody who missed out on part of it, we will be sharing the video with them. And thank you, everybody.
And I'll make one more statement, and I always, kick myself for saying it. I'm more than happy to talk to people that have questions. Send me emails if you have questions about this, or you're at a juncture or some event. I can't reach them all, unfortunately. I've been over inundated in this virtual time frame. I do 3 or 4 of these a week, but I really want to make myself accessible, to especially community banks, credit unions, lifeblood of the communities, and want to make sure that I'm doing what I can. So whether it's through the association or other means, feel free to reach out.
Thank you so much, Jim.
All right. Great seeing you all.